All right, thank you everybody for joining us for a State of the Market webinar with Mike Flanagan and I. We're going to spend probably a good hour and a half here probably talking about the state of the market and a lot of things that are going on. I open this up to pretty much anybody who wants to listen. I know a lot of companies and lenders and attorneys and agencies are not really making this specifically open to everyone. So I think the consumer isn't watching or doesn't consider it to be relevant to them. But I wanted to open up to everybody because it's important. We're all in this together. And I think it's important for people to know the truth of what's going on behind the scenes and what we're seeing and feeling. And just to give some people some good information on what's going on, what's happened in the past few weeks, and what we see moving forward. Mike and I have both been in the business a considerable amount of time. We both went through the last recession. Hopefully we don't see that. Certainly the signs are feeling like there may be some level of a recession, but we just want to prepare for it. And we want to know everybody to know what's going on and how we can help each other get through this day by day. So I did start recording this, and we will make it available for everybody after the fact. But welcome, Mike. You still there?
I am. Thanks for having me.
Let's just jump into it. First thing I want to talk about, obviously, most of you saw yesterday Governor Baker specifically named real estate agents as an essential service. I know you guys pretty much, Mike, have probably been considered essential for at least a week. But yesterday, Governor Baker gave us some clarification saying that real estate agents are considered essential. I have been pondering that since yesterday, and I'm still not sure I'm completely on board with it, or morally and ethically, I go back and forth probably every hour. Mike, how are you feeling on that?
I think that I would deem real estate absolutely essential. Would I be hosting broker opens right now? No. I would use common sense with it, but I don't know what is more essential than housing in this country. Housing in general, people need places to live. The path to home ownership has and likely will be the largest path to wealth creation in the United States, and therefore I think keeping that going and keeping it chugging is absolutely essential. I think that talking about recession and where things are going, the longer you have the housing market in cold storage, essentially, the longer you're going to see these things take to ramp back up and get back to normalcy.
Totally agree with that. I think Governor Baker kind of had to get to a point where he was really weighing, keeping as many people safe from corona as possible, and making sure that we don't head into a depression.
Yeah.
I've heard come out of some people's mouths, which I don't really want to hear right now. But I mean, if it went on longer and harder, it could end up there. So I think he had to make a decision to, label us as essential. I think the morally though, we have to decide what parts of real estate or as we move into the next month and week by week is what is considered essential.
Yeah. And I mean, you get a lot of the knee-jerk reactions to some of these things that are driving some of the, hysteria about it. The biggest thing that I hear repeatedly, and the biggest thing that gets brought to my, in my RAS, and I hear just people in conversations or in things like this, is as bad as things got in 2007 to 2009, unemployment really kind of peaked at the 10% range. And where we're seeing that unemployment could hit 20 or 30%, that's causing a lot of panic in the communities and especially the real estate community that saw everything grind to a halt over that. I would say you need to look at how those things happened. 10% unemployment over 99 weeks, and we had people batching out of unemployment. You could really only collect unemployment for 99 weeks. So who knows what the real number was? 10% of the people were on unemployment, but they were on for such a prolonged time that then they got off of unemployment after the 99th week and still didn't have any kind of job. That's a lot different than a flash in the pan 20 or 30% because we've had to shut everything down. A lot of the people on unemployment or that are going to be collecting it are out of necessity because the businesses were shut down. It's a matter of how long does that last. That's largely going to drive this into, I don't think there's any way around a recession when you shut the economy down, for 2 weeks, let alone 6 weeks, 10 weeks, 12, 16, who knows how long this goes. I think you're going to see some form of recession. And, I don't have the numbers off the tip of my tongue, but just things like if GDP drops 20% or 30%, it then takes a 50% increase to get back to it just because of the way stats work. And that's going to be stuff that who knows right now. Anybody that's giving you, hey, the housing market's going to crash because we're at 30% employment doesn't know. And I think that's a hard conclusion to jump to. The difference, I would say the main difference that I'm seeing between what's happening now versus what we saw the last time is that, the last time it was an internal combustion. The housing market itself was what collapsed. And that's what caused, the large ripple effect of the recession. This is an external combustion that is really putting pressure on every single kind of business. So let's take a look at what we have to work with. You've been deemed essential. I've been deemed essential. So it's not as easy to find the buyers. It's not as easy to find the homes for sale, but they're there and we can work and we have a path to creating a living. If I'm a hairdresser right now, I can't even open my doors. I can't cut anybody's hair. I can't do that at all. So at least we're one of the industries that has a path to generating revenue right now, to keeping our doors open.
Yeah, that's a good point.
If you want to look at the bright side of things.
Yeah, no, that's for sure. And I would tend to agree. I do feel we probably are headed towards some kind of recession. I hope it's a small one and maybe a small period of time. But even when everybody can go back to work and these businesses can open again, they're not going to hire all those employees back right away. Most of them are going to use up the cash flow they had on the rent payments they're still having to make, or the loss of business. So they're going to run on skeleton crews for a while until they can really feel confident in hiring those people back. It's
retail. It's going to be a tough landscape for retail. Anything where when you have times like this, discretionary income is what is getting depleted. People are spending that money that they would use to buy a new fridge or to get that new couch, to go on vacation. Vacation you can't even do right now. Who knows when that's going to come back? But that discretionary income is what's being spent right now in preservation mode. And so those are going to be the things that have very large ripple effects downstream on where you end up. But you're absolutely right. You're not going to go to direct layoff to rehire right away. I think you're going to see a very large rebound once people can open their doors and get back to some normalcy. But take even a restaurant that gets to finally reopen again, they're going to have to space tables. They're going to have to space, there's going to be these new parameters of just how the layout.
Get in and get a drink.
Right. Like, do you see
the first
elbow to elbow? Are we going to stand in bars like this far apart from each other and make sure, that there are going to be lines at bars to get drinks and stuff? And, that all that stuff is yet to be seen. Anybody that's trying to project that has no idea. And I think that's coming, jumping to conclusions is a natural thing. And, people like to hear the best, assume the worst sometimes. And it depends if you're optimistic, pessimistic, but you tend to go to one end or the other. And that's what we're seeing a lot of right now.
Yeah, for sure. And so moving on to number 2 a little bit, what we've seen is pretty much a day-to-day changes, which is, you feel one emotion one day and another emotion the next day. And sometimes, as you say, from one end to another, sometimes you're on one end to another every day. So I think it's important to look at the last 3 weeks and say, for one, I saw a lot of collaboration and everyone in the industry trying to just figure out, how do we proceed from here? How do we keep deals moving forward? How do we keep closings together? How do we keep proceeding? And then we kind of saw the bigger scare of, stay home and what does that mean to us? Now we're kind of hearing we're considered essential. We maybe should get back to work in certain ways, although there's going to be a lot of differences of opinions on, where you fall. Do you get back to work as much as normal, or is it just essential? What's essential? And no, I'm staying home until this is over.
Right.
So many divided viewpoints on this. What I see is important from the last 3 weeks is it's going to be the same kind of stuff for the next probably month, at least, is that day-to-day, let's just take this day by day. Let's try to go through it, try to find solutions, try to figure out what the new norm is going to be. And at some point in the future, there's going to be, what's considered to be a new norm of doing business, because it's certainly not going to be back to business as usual.
Yeah, I concur. And I think that's probably why people are struggling with this so much, because, I'm a results-oriented guy. I generally reverse engineer my daily schedule, my pipeline management, my workflow, my business. I basically say, here's where I want to be, whether it be end of the week, end of the day, end of the quarter, end of the year. What do I have to do to get there? And I can't really do that right now, because I don't know what unemployment rates are going to get to. I don't know what lender guidelines are going to be from day to day. Overlays are what we're seeing come into the marketplace a lot. So I don't know of my current pipeline deal flow of what we have of what we can get locked, of what we can work with. I would say our application volume is still high. It's still very, very high. I'm surprised at how high our purchase pre-qual application volume is. Now we have a very
people
good
are definitely getting pre-approved, but they're on the sidelines. It's good to hear that there's
exactly
approved, because we're kind of wondering, our buyer is going to continue to come into the market, and that's a good thing to hear, that they're at least getting pre-approved, and we're seeing views up online and some registrations continuing for lead gen. But
my lead gen has ticked up a lot. Like I actually had to cut back our lead spend substantially, because we were seeing a lot more leads come in than we could even handle. So now we're probably generating about the same leads that we had on 1/5 of the spend. We're not effectively working them, but in the small, mainly just because of other forces. If I do a lot of financing for new construction in other markets. I finance Taylor Morrison, Toll Brothers, Lennar. And, we've had a lot of people that built homes 6-9 months ago that are coming up with deliveries due in the next 90 days. Some of them don't have jobs. Some of them don't have loan programs. So we've been kind of focusing energies towards rectifying those problems. And those pop up on your normal day-to-day here. Someone's pre-qualified, they're a hairdresser, they can't work. Some lenders have deemed that even if it's, a small business owner that owns a hairdresser thing, like they're deemed not essential, so they're not allowing that income right now. Some are interpreting it differently. We've been handling a lot of that. So the lead generation hasn't been getting the same attention it normally does, especially this time of year.
And it should.
But the flow is still coming. Yeah, the flow is still there, and I'm shocked at how much comes in.
Yeah,
I would say. Go ahead.
I was just gonna say, and the focus should be on those that are out under agreement, which is kind of why I wanted to talk about number 3, which is, I know on the real estate side, we're just working through things, trying to make sure we can get smoke certs. If we can't deal with that, how are we going to deal with finals? How are we going to deal with, Title V's and inspections and all that stuff when people don't want anybody in their house? And I know everybody in the real estate side of it, agent side of it, is just kind of working through it day to day to keep everything that's under agreement moving forward. And I've seen very little fallout. I did hear one of my agents say that yesterday they got turned down the week of the closing. It was supposed to be closing this week because of the changes in that lender's FHA guidelines, which we'll talk about next. But it's good to hear from the lending side. It's the same thing. It's like, let's keep committed to these people that are under agreement. And it's, people have been asking me, like, is every lender looking at this differently? And I say, I doubt it. It's probably a loan-to-loan basis. Like, are they doing last-minute verifications of income now, of employment now, or what? How are they dealing with all this?
Yeah, so I mean, you are seeing this vary a lot from lender to lender. Lenders have two things that they can do. Let's circle back a little bit to some
Okay.
of the challenges that we saw in the marketplace. We had rates drop fast and furious, and we had this massive flood of application volume come in. It got so crazy, and then the Fed makes an announcement like they're lowering interest rates to zero, and we just have a flood of inquiries to the point where we had to put out some videos and some mass emails just because we couldn't even handle the call volume that had been coming in that current time. I think I got 200 phone calls Monday after the Fed cut asking for the 0% mortgage. Like, it's just insane what people pick up and hear and want to hear. So when lenders get overwhelmed with applications, lenders are adhered to Equal Credit Opportunity Act, ECOA, we call it. ECOA dictates we have to take an application from anybody that wants to apply. Okay, lender has to take it. It can't discourage anybody from applying legally. You could be, you could be redlining one class of people, not taking applications. There's a whole bunch of reasons that you want to always take the application that comes in. So there's two ways that lenders can meter that volume. They can't just be like Apple that sells out of an iPhone. They have to slow it down somehow legally. And the number one way that they do that is price out of the market. That's the fastest way that they can do it on short term, on a very short. Make the pricing unattractive. So if my pricing's 3.25 this morning and I hit, call it 1,000 locks for the day, I can't handle any more than that because I'm not going to be able to disclose them in the timeline that ECOA gives me. I'm definitely not going to be able to decision them in the timeline that ECOA gives me. I'm not going to be able to meet all of my federally regulated obligations. So instead of offering 3.25 still, I'm going to price up to 4 because people either don't have the benefit of a refinance at 4 or don't want to, or now think my pricing is bad. That's where you're seeing a lot of the pricing challenges right now. And it's hard you have a lot of good lenders in the marketplace. This isn't a specific to me problem. And if you've gotten this from someone at Fairway or Guaranteed Rate or Movement, any of the really good lenders in the area, it's not them. It's not the salesperson or the loan officer. It's the market. And we get a lot of calls. Hey, what's your rate today on a 30-year fix? I can price it. We were at the point for probably a 2-week span where if someone was calling me on pricing at 4 or 5 o'clock, I'm like, hey, we really got to look at this tomorrow, because a lot of the lenders had absorbed the amount of locks that they were willing to for the day, priced out of the market. You got to look when pricing opens. And honestly, who knows what happens tomorrow? Are you able to put me on the screen share for a second?
Yeah, let me see if I can switch it over. So basically, like it's up to your lending company or the company that you're
right
on the loans to decide what they're going to put out for.
Yeah. So if you work for, say, Fairway, direct lender, they may have more options than just their own portfolio, not their own portfolio, their own direct lender stuff. But if they run out of appetite for the loans or capacity for the loans, they're going to price out. That's not because Fairway has poor pricing. It's just because at that point in time in the day, they had hit their limit. And that's something that, I got a lot of calls from an old direct lender that I used to work for. The loan officers were not able to place loans for a couple of days because they had capacity issues. And it's like, just be patient. It'll come back. You have to work through these things and get to a certain, it just takes a lot of higher level of patience to find the right thing. We were telling a lot of people, especially in the refinance buckets, let's look at what your target is. If you're trying to target 3.25 or 3.5, like, we have to have your application in and ready to go. Because if I quote someone at 2 o'clock in the afternoon and the lenders, basically run out of capacity by 4, by the time they really get an application in, I work it up, they get the necessary documents that I need to get in and put it into law. Like, it could be 2 or 3 hours by the time that passes, and who knows what the pricing was. That is not normal. That is not typical. Any given year, about $2 trillion makes its way through the mortgage system. That's annually what goes through. And by some of our analysts' estimations, close to $5 trillion was eligible in trying to refinance in the 30 to 45 day window there for a while. So you're talking 2 to 2.5 times the annual mortgage volume cramming itself into a 30 to 45-day window. It's just not possible to get through there.
Right. I just tried to make you the host. Did you get
Let me see.
saying that you could, or try to share? Try to share again.
No, I didn't get it.
I don't know what's going on with that. What
That's all right.
So yeah, as far as FHA loans go,
Yeah, so this is where the second half of this comes. So the pricing out of the market is a short-term thing. That's something that they can do on a day-to-day, hour-to-hour basis to slow volume. The larger scale thing is overlays, and this is what you're seeing on your FHA right now. Lenders are really being limited by the capacity of what they can handle, not just in application volume, but also in market logistics. Lenders' ability to lend, and I don't want to get too high level here, but the term is mark to market. Lenders can lend based on the value of their portfolio. And again, this is a massive oversimplification. So industry people that are on this, don't kill me here. I'm trying to bring it to a
we agents and consumers need a dumbed down version.
And it's not a dumbed down version. It's just I'm trying to really streamline it because we can go hours into the complex things that are pushing this around. But on mark to market, your value is based on the market value versus book value, and lenders can lend based on their market value of their portfolio. Well, when rates go really low and people start paying off loans, servicing values decrease, and when servicing values decrease, the market value of these companies decrease by some estimations, very good estimations, almost in half. So the lenders have now a certain amount that they can handle just in workforce and flow. Now they have a certain amount of capacity that they can handle, just what their sheer value is in their warehouse line capacities. It also takes a lot of cash to get from point A to point B and get these loans sold to the agencies. And with all lenders and the stock market crashing, everybody's getting margin calls. So the ability to push all of this through the system is getting narrower and narrower and narrower. So what they're doing is the first thing that you saw go was non-QM. Non-QM are your non-agency loans, right out of bankruptcy, bank statement loans, very risky portfolio products. The cash dried up for those a couple of weeks ago. And so we saw those things go away. We don't do a ton of those. It's never been a big market of ours. But they were big for some people. The next thing to go was jumbo. We're lucky to be in a high balance area, so we're not getting hit on this as bad as other places are. But anything over conforming or high balance limits is considered a jumbo loan. Worcester County has a pretty basic one, but in Middlesex, Norfolk, you can go up into the 600-700s, Nantucket 700. So these different counties have higher balances. But when you go over that, the jumbo loans are very cash intensive. They're held by banks, they're held in portfolio. Well, the cash dried up for those. Now we're starting to dive into not being able to push all of this through for lending and warehouse capacity. So the first thing that's starting to go is government products. Not a lot of people are buying the risky government products. There's talks of Ginnie Mae stepping in and backing some of these lenders to try to jumpstart that. But again, everything's kind of being reactionary right now. So the way that a lender long-term can meter this volume is with overlays. We used to have, 10 lenders that could go to 580 on an FHA. We have one lender that would go down to 500. It took 2 weeks to get all the letter of explanations together to even get it in. I don't think we actually had them in mass, but all of that is gone. And we saw basically 580 was a pretty common benchmark, 620 to 580. We saw that dry up pretty quickly. And now a lot of lenders, 620 was kind of the automatic number for FHA. That's kind of been pushed to 640 and 660. We still have some places that will do 620. That's kind of one of the fortuitous reasons that Kim and I started this company and became, timing wise, became brokers when we did. If I worked at a captive lender, ABC Mortgage, I don't like calling out names because I don't think that any of these challenges you're running into are specific to the lender that you're working with. They might have their own issues that I can't really speak to. And, please don't say my lender is doing 620 and my lender says no, 660 is the max. because they're all a little bit different. But we have access to, I think we're approved with 16 lenders right now. So we can usually find who has the appetite for that. But we're seeing by and large, maybe 2 or 3 of them really only want the 620, 640 stuff anymore. And even that, the pricing's not super attractive. So that was kind of last week's problem. We were scrambling to get all of these 640, 620 FHA loans in and locked. If you miss that boat, will that come back at some point? Yes, but not in the short term. A lot of the liquidity issues need to be fixed, and these value issues need to be fixed, and they're not quick solutions. So, I would say if you have a buyer that's in that 620 range, make sure your lender is still doing it. Get them locked if they're under agreement. I think I sent a few texts out to some people that are probably sitting here on this Zoom, like, hey, I know you've got these 4 people. I don't know if they're all with me either. Like, go get them locked because I know they're close to agreement or not. So those were the challenges of last week, and you're starting to see those guidelines get stricter and stricter. This does go from lender to lender. United Wholesale Mortgage, we probably sent 90% of our business to United Wholesale in Q4. They were priced very well. They were very competitive. Their system was fast. They were the gold standard of wholesale mortgage for a very long time. They want nothing to do with this market. They are priced so far out of it. They're not competitive. They have overlays in place now. 40% DTI on conventional, they really only want to handle. So they're doing that because they don't want to put themselves at risk in this market. They're going to wait till it shakes out and then hit the ground running. Luckily, you've got 13 other lenders that we can work with that do have appetite for this market. And if I was going to show a screen share where we can sort everybody, and it clearly visualizes who's in and out of the marketplace. Before I ran it today, UWM's at the bottom. Let me recheck this pricing sheet. Freedom Wholesale, one of the largest direct non-bank lenders out there. I have a 25% down conforming purchase with 800 credit. They're priced out of the market. Luckily we can go to the top. We have Stearns, we have Home Point, we have PennyMac, we have First Guarantee, Remen. Like, we have all of these lenders that are in the market, and that's where we have a competitive advantage right now over being just, held captive to one lender. If you have your lenders that you like in the marketplace and they're not competitive right now, bear with them. Doesn't mean they're not smart or they're not hardworking or they don't know what's going on. Their lender that they're captive with right now just doesn't have the appetite for your loan, and that will largely come back over time. But as of right now, in the constraints that we've got, that's the biggest issue, and that's where you're seeing FHA loans and VA loans and your government stuff. That's what the appetite in the marketplace is kind of the next bucket that's driven off, and you're going to see those get harder and harder to qualify for.
Can you share now?
Let me see. No, disabled participant screen sharing.
So I heard somebody else say, and I'm just curious if this is true, is when these guys are pricing themselves out of the market, is it because they're scared that a lot of the loans that they've already closed on, they're going to own the recourse on?
Yeah, it could be. I mean, that's kind of a narrow edged view of what they're going on. They're probably waiting to see what is going to, they're probably not able to capture new loans at the rate old ones are running off. That could be an issue that they're at. They don't want to cannibalize their own, what we call early payoffs. So you can see some of that happen. I would say that's probably not the reason you're seeing them price out, because say I am, example, Home Point Mortgage, and I made a loan to someone at 375, just because I've priced out doesn't mean they can't walk across the street and get 3.25, and then I own the recourse anyways. So I still have to pay back whatever unearned servicing there is. I don't necessarily think that's the main reason. I think being priced out, the 2 main reasons you're seeing people priced out is either the capacity to get them done and processed within ECOA, or their warehouse capacity, the ability to fund them and get them to the closing table. or get them from the closing table to the aggregator, Fannie, Freddie, Ginnie. That's probably what's being impacted and pricing them out.
Yeah. I mean,
Those are the,
yeah, I mean, looking ahead and how, obviously it's in some cases we're going to see a little bit of fallout. So far as a company, we haven't really seen much fallout from under agreement. So it seems like a lot of people either got locked or lenders are still trying to work it out. And maybe we won't really see the impact of some of that fallout of contingents under agreements until April. But so far that impact seems not as high. And clearly these changes in what they're willing to do for loans and who they're willing to approve is going to knock some people out of the market, as will the unemployment, whether they have a job or not.
mm-hmm.
People that are unemployed that we're going to buy are not going to be in the market, and people that, we're on the edge that are getting kicked out because of their credit score or the rates being higher, the debt to income ratio is certainly going to knock some people out. It's just a question of what is that percentage. Obviously in a market that's been inventory driven and high demand and low supply, it may not directly or immediately impact the market when everybody gets back out there, because there still will be a lot of buyers.
Yeah. And that's kind of what we've seen. I probably had 4 or 5 clients that I didn't expect to hear from this month, last month. People that got frustrated last April, and they're like, hey, is this a good time to kind of get out and shop? I'm like, kind of forgot about you. You got frustrated. We couldn't find anything in your price range. And then they circled back, and, we have a bunch of them under agreement because the marketplace was a little bit more their speed. And maybe they didn't necessarily get a discount over what they would have got last April, but it allowed them to not be competing with 30 offers. So, I would say
logically, some people can't get out of their own heads to look at a house and make an offer an hour later. I've had buyers like that too, that just they're like, no, we can't do this. And it had nothing to do with the price. It had to do with, I like to sleep on these kind of decisions.
That's amen. And so I got one friend of mine, colleague, very decision oriented guy, likes his process. And this spring was and they're not in a super competitive price point. They do well for themselves. They're looking in the, $600,000-$700,000 range, Southborough area. They've got now all of a sudden the time they can go look at a house and go sit home and think about it. I'm like, dude, how lucky are you to find the one market where you could buy like this in the last 5 years, So there's certain people that can take advantage of the way that this is working. I would say my biggest, piece of advice would be just don't stop working. That's probably one of the worst things that you can do. I think that I saw a lot of my friends in the mortgage industry go out of business the last time around because they just stopped working, and they, said, well, I'm going to wait and ride this out. And, a year later, they never got back into it. They never got back on the horse. I don't think this is going to be as prolonged as a, slow housing market burn that is going to create massive inventory foreclosures. You will see foreclosures and defaults go up. That's a fact. But a little inventory in a place like the Worcester and Metro West markets isn't necessarily the worst thing for housing turnover either. And what real estate agents need are housing turnover. The number of transactions has just gone down. If there's only 25 homes to sell in a township of 25,000 people, only 25 deals. If there's 100, 200, more turnover, more options, more more money in the real estate market, I think you might see this be, I hate to say a good thing, but you might see this generate more money in the real estate marketplace here once things do emerge from this.
It'll be interesting to see how much inventory comes on the market after this.
Yeah.
If a lot of people just look at it like, you know what, we're just going to stay put for the next 6 months. We were going to think about selling, but we're not. Then it's not going to be a number of buyers in the market problem. It'll still continue to be an inventory problem.
Right. Let me pose a hypothetical and I hate answering hypotheticals, but I like throwing them out there because this is one that we can debate. So advance me in my stage of life. So now I'm Mike Flanagan. I'm 68 years old. My kids are grown and gone. Okay. Nearing retirement age. I have a paid off house in Shrewsbury, probably about 450 grand estimated value. I just lost 30% on my 401k, my IRAs, on my investments with the stock market declining. Okay. So I'm at retirement age. I need to generate capital. Do I liquidate the house that I've been selling on, or do I liquidate the securities that have lost 30%? I don't think the $450,000 home is going to decrease 30% in value in this area. If I was in a job-stricken area with more, challenges, that could definitely be the case. But in a place like Shrewsbury with high demand, do you think that home is going to drop 30%? You might see these, older generation who control a lot of the inventory say, hey, I can now there's less competition for these downsizing homes or condos or whatever it might be. Maybe I'll do that and I'll liquidate my primary residence, the downsizing home that I haven't known what to do with for a long period of time. Mm-hmm. Which asset are they going to sell to generate capital? That's a decision that people are going to have to make here coming up. I don't know which one is going to be made, so don't take that as
I hear you.
But it's a thing to think about, and it's a thing to consider.
It's also a thing to think about. I was thinking about this the other day, is how many people that have been, scratching to afford their big house on two incomes are now saying,
mm-hmm.
why do we do that? Why? I mean, it's maybe 1.25 income is okay, but why we should be looking at our household as we can support this mortgage with one income instead of two. Is how many sellers are going to just say, this is stupid, we just want to get a little bit more affordable house, or have to because they're not going back to work fast enough. So, when we were obviously going into the last recession, we had more time to think about this.
Right.
Signs were all there and stuff like that, but it became a market of, who's motivated, and right now where we're trying to all morally decide what, I from a real estate agent perspective, I think you need to do what's safest for your family and
absolutely
make those decisions individually. But also if you are getting out there, it's like, are you just going full bore and you don't care, which I think is ethically wrong, or are you going forward with the idea of who's motivated, who needs to sell, who's in a financial position where they have to sell? Maybe they bought two houses, maybe they're not going to be able to afford that second house now because their job is going away permanently. There is essential needs out there for real estate, and if
mm-hmm.
For clients that we've signed up for, whether it's on buying side or selling side, I do believe that in certain cases we have an ethical and fiduciary duty to our clients to act on their best behalf if they're in a financial position where they have to do something.
Right.
So it's going to be a weird transition because we're going to go from making those kind of decisions, and unless it's like a lockdown, it's going to go from making those kinds of decisions to when is it okay to start going out with the buyers again that are just like, yeah, if the right house came on the market, I'd buy, but
mm-hmm.
Otherwise I'm not, the tire kickers, or, I know a lot of us real estate agents now are asking a lot of questions before we go out, and we should be at this point is, are you pre-approved? Let me see your pre-approval letter. Have you looked at Google Earth? Did you see that there's train tracks like 100 yards behind the house? You're asking all these questions before you even proceed to showings. A lot of agents should be thinking about virtual tours, virtual open houses, that kind of stuff. But I don't think there's going to be a clear point in time where we say, okay, well, that's over. We just go back to business as usual. So we have to start thinking about it from a real estate perspective. How are we going to proceed through this safety market, these, real estate being affected for health issues, not economy issues, and then also having to maybe contend with a changing real estate economy.
Yeah.
That's a double-edged sword right there.
No, yeah. I couldn't agree with you more. And I think the biggest thing you hit the nail on the head is be safe. and don't bring people into people's homes unnecessarily. And my wife and I actually are selling our house right now. Just before all this hit the fan, we bought a new home. We're in the process of renovating it when all this came down, and we're selling our house. And our real estate agent has just been very smart about limiting. My wife is pregnant as well, so we have that added
Oh,
risk
wow.
layer that we need to watch.
Congrats.
Thank you, thank you. 26 weeks, baby girl on the
Nice.
way. So knock on wood, if everything goes good, we'll stay healthy and sane. But um, she, our real estate agent reached out to us and was just like simple things. Make sure the bedroom doors and closet doors are open. If people don't have to go in and touch those things and open them, that's one less point of contamination.
Have your seller turn on all the lights,
Right,
and when you
right.
leave all the lights on alone. So you basically touch as little as possible.
Exactly.
Yeah.
Gloves and like little foot booties at the door. And that's what we did. And, I think that being smart and responsible, not just blowing through the place with, 3 or 4 buyers and,
Yeah.
just touching everything, just be mindful and know what you're getting into and doing. I think a part of the reason you and I always kind of got along is we have always been on the forefront of, the digital ability to do this job.
Yeah.
You guys have a lot more interaction with the client than I do. You drive them around, you show them homes, you sit at coffee shops and mull over the decisions with them. They like to know that we're local, but they don't ever really like to come into our offices. So, we've been a little more digital oriented, and we've been able to kind of be behind that third wall a lot more than you can on the forefront. But we can still lead gen, we can still educate, we can still do our jobs. And what I think agents should be doing is building that nest egg and horde of prospective buyers that we can then turn around and get on, when these things do open up and become safer to go out. And there's by all indications some seasonality to this virus too. Things will be safer in July, warm weather, things like that. So have a plan for it. Maybe have some teams that you're working with, because eventually, hopefully, you do have 5 or 6 buyers that all want to go at once, and you don't want to be spread thin, showing them 6 people homes all in the same weekend. There's going to be people that flat out have to sell houses at the end of this too.
Yeah.
If my wife and I didn't sell our house at the time that we did, I don't know that we would still have it on the market right now. But at some point we would have to sell it because a lot of the renovation money we're using for the new house is being tied up in it. Some people you're gonna have a lot of job relocations.
Yeah. One of my agents has got one that's got to go on this week. They're relocating to Washington State.
People got to go where the jobs are, and conversely, that could bring a lot of people into the state because we generally have had one of the healthier job markets here.
Yeah.
So,
I mean, we're not creating a lot more supply. So I don't see the low inventory problem going away anytime soon. The only way that would happen is if a lot of people get displaced from home ownership.
on the scales that we're talking about, yeah, it would take large scale default.
Yeah, I think, yes, you'll see less buyer demand, but in some regards, I don't know if you'll notice it when you're showing houses or listing houses. You'll still get offers. You may not get as many, but you still could get bidding wars. Initially up front, it's definitely going to happen because everybody's going to be pent up in their house, and just like the restaurants and bars, and it'll come back. It may not come back all in one day. It might be gradual, but it'll come back. And then the impact, I think the impact will be seen more third and fourth quarter.
Yeah. That's the third quarter is when you're going to see the economic data come out that really shows how far this went and how heavy hitting this became. And the other thing that I'm looking for, and here's the hardest thing, again, it doesn't matter if you're working with me or another lender or another broker, none of us are going to have the answers that you're looking for right now. We can give you the landscape. We can tell you what the forces are that are at play, but you've got to remain flexible because these things are fluid. They are changing from place to place. And just because, one lender says you can't do a 640 FHA doesn't necessarily mean that's blanket across the board. You've got to you've got to kind of source your database and find out what the options are. Don't take anything that I'm saying as Bible, because I have my pricing analysts, I have my news sources that I go to, and I'm giving you what is being sent to me. And sometimes from the beginning of the day to the end of the day, that information can be different based on what the guidelines say that come out, how attorneys interpret them, what a lender's appetite for risk is, where the market's going. We've seen some really good market stability in the last 3 days, and that should help. But I'm not expecting to see the wide scale stability that we need until we have a defined, okay, it's safe to get back out there. The things I'm looking for: when can someone go get their hair cut again? When can they go to TJ Maxx or Home Goods and buy that like credenza that they don't need? When can they go do things that would be considered non-essential, see a movie? That might be a little bit extreme, because I don't know if people are going to flock back to places where 1,000 people sit in a room right away. But when can you go walk around the mall? When can these things, restaurants, open? Until those things start to happen, I think you're going to see a lot of volatility in the market, in the mortgage market, in the real estate market, because
Yeah, I
everything's
don't know when
reactionary about that. And who knows
that's a
when?
hard thing to look at and say, when is that going to happen? Who knows?
Yeah, exactly.
And that's why, like, even if people are selling now, from a seller's perspective, I don't think I'm looking at, it's pretty much a lot of people still on the sidelines. So is it time to panic as a seller? No. But moving forward, I think, sellers need to start thinking, if I get a good offer in hand, it's fair offer, you take it and you run. The last thing any seller should be making decisions on, the last thing you want as a seller is to get into a position where you're chasing the market, which is you're higher than the competition, and then the competition price reduces and you price reduce a little bit more, but you're still above the competition. You don't want, having been through this once before, you don't want to be a seller that's chasing the market. You could literally, in 4 months' time, finding yourself losing. If we do see it end up in a recession, you could end up losing 10 to 15% of your value in a couple month period.
Yeah.
I don't really see that happen right now, and maybe in a month the signs will be different. But right now, the inventory is still low, and it's going to be low after this. And there's, even if 25 or 30% of the buyers that were in the market get knocked out, there's still 75% of the buyer volume that was there before.
Yeah.
And they're probably not. I wouldn't, as a seller, I don't think anymore you can just say, well, let's throw it out there at a high price and just see what happens. That's a wrong strategy, in my opinion, right now. You got to be fairly priced in the market. And I think as you come out of this, there will be buyers that are willing to pay a fair price, knowing that they're going to get a great rate. And they're going to be in that house for 10 to 15 to 20 years. I've got buyers that have been asking me that question. And they say, well, should I wait? Or if I see the right house, should I buy it now? I'm like, you probably should think about buying it now. If you're going to be there for 5, 10, 15 years at the rates at what they are right now, why wouldn't you? Obviously, I think people are starting to look at their home and really looking at a different perspective of, like, this is my safety zone. This is where I have to come home to and be comfortable. And some people are probably feeling a little uncomfortable in their house right now.
Yeah, no, I don't disagree. And I think, as a seller, to drive price on your house, there's really only a few levers that you can pull. There's price, you know what I mean? The main lever that you can pull. If you lower the price enough, somebody's going to buy it. That's a fact. Buyer pool. How many available people are there to purchase your home? And I think that's a really hard one to predict right now. So, if you have someone that has to sell, like, what can you do to increase that buyer pool? Make sure that it's as attractive as it is. Make sure you can take most of the objections away. Make sure that you have the things that, FHA is not deceased. It's just becoming restricted. So making sure you have those FHA objection items, your chipping paint, your missing railings, your common ones, exposed wiring, make sure those things are being addressed when you go to list these homes. 660 is not a great conventional buyer. It's a great FHA buyer. So there's this window where FHA is still going to have its necessity. And even if you just can't squeeze through the 580 person that's gone away, I mean,
You might
maybe a
have an
slightly,
uptick in FHA loans just because if people had 5 to 10% to put down, if they
yeah.
ate some of their savings a little bit, they may be looking more. They might have great credit, but they were now they're going to not have exactly the same down payment money as they had a month ago. They might end up in FHA.
Yeah, very well could be. If someone needs to go below that 5% mark, isn't a first-time home buyer, doesn't have access to Home Ready, Home Possible, you could definitely see those people kind of slide into an FHA land. And then multifamily homes, the things that we use FHA for a lot, but you know, your 203Ks, those are going to be difficult in this market. Your very low FICOs, your high debt to income. That's the thing that we're seeing a lot of restrictions on. We just had one lender. We had a couple loans that we were looking to place there. If they're going over 50% DTI, very common for FHA, they need to have 6 months reserves, and 6 months reserves doesn't usually jive with a 640 credit score and high DTI and low down payment. You know what I mean? So they were kind of pushing themselves out of that marketplace, and that's the way that they did it. So, and just because that was that lender's issue du jour doesn't mean that we didn't have another option to push them someplace else. So again, a great benefit of being a broker in this market is that we do have those options available to us that we can move around. I'm just not captive to that one risk appetite for the day.
Yeah, for the loan officers that are listening and lenders, what's your advice over the next month? What they should be thinking about? What should they be doing?
I'd say keep educating yourself. Stay up on your company's guidelines. They are going to change. Be patient. Focus on what you have that you can close. Be frugal and be mindful of where your money is being spent in the next 30, 60, 90 days. This will not be as prolonged by all estimations as the 2008, 2009 buckets. And just know that these things will come back. Will it take 6 to 9 months for FHA to resume to the normalcy? Maybe. It could be a year. I don't know that. Nobody does. So, and anybody that's telling you definitively when we don't know when we can get our kids back to school, is just guessing and speculating. And I think that's where my biggest piece of advice would be is just focus on the things you control. Stay out of the hoard mentality and don't get hyper focused on the one piece of bad information that comes across, because largely nobody knows. We're in uncharted waters, man. That's and the more you realize that things are going to change, the more adaptable you'll be, and the better suited you'll be to weather this.
Yeah, for real estate agents, I can't preach it enough, is just you got to keep working at home. It's so strange. Agents are having a really hard time with this because they went from spending 90% of their time on the road, not in their house, not at a desk, to almost 100% at their desk. And if I look ahead, I don't see, it's not going to just completely trigger overnight. It's going to be a transition from working at home to more and more and more and more and more over probably a 4, 5, 6 month period. Back there, hopefully they're back 90% on the road. But I see a lot of agents just kind of sitting on the sidelines. I can't do much. There's a lot of things I think they should be doing, working on their database, working on their pipeline, calling every single client they have, checking in with them, make sure they're healthy, make sure they don't need anything personally, having nothing to do with business. So they need, but also finding out what their thoughts are on the market. Everybody, just like we've seen, everybody has a different opinion. Like some people are just like, nope, not for me. I'll wait till next year. Some people are like, oh, if I sell the right house, I'm still looking. Other people are like, oh, I don't want to put my house on the market. It's going to be completely different from client to client. And the only way you can find that out is to talk to each and every client and know, who's still going to be in your pipeline for potential closings in business this year versus not. And that's all stuff that agents should be doing right now. And I've said it before, and I don't think that many people listen, but an agent's database should be better than it's ever been coming out of this.
Yeah.
Like, this is the time to fill in all the gaps. This is the time to, if you don't have an email address, you get an email address. If you don't have their home address, you get their home address. Like, and because it's going to be hard. I mean, I've heard other industries say the same thing in sales, but basically there's still an opportunity to have this be an even or growth year for a real estate agent or lender, but it's going to mean doing, 80% of your business in, a 4-month period or
Yeah.
5-month period. So it's, at some point you're going to be going gangbusters, and it's not all, maybe not, you're going to be all the clients you expected to close this year. It might have to be new clients that you find that are motivated.
Yeah.
There's going to be even in the down market. I always say, having gone through that last recession, a coach early on told me, your economy is your economy. Regardless of what's going on in the global economy, your economy is your own economy. There's always going to be people buying and selling, even if it's down 20% or 30% from what it was the year before. There's still a ton of business going on out there. You just have to go find the right business. And
Yeah.
so agents really have to be thinking about that, and not, the other reason to keep working and working from home, like you're at the office, like you're putting in the hours, is it's damn hard to go from speed zero to speed even 50. You can't shift that.
Yeah.
You get into the mode of, it's just like making prospecting calls. You're not going to be great the first call you make. You're not going to be great the second.
Funny
say coaching
about that. Like, working from home is such a difficult mindset. I'll share one little tidbit, and it's going to make me look like an absolute lunatic. But when I had to work from home 100% of the time, the only way I could get into the mindset was I would get up, I would shower, I would dress as if I was going to the office. I would literally get in my car and drive 5 minutes away and 5 minutes back to my house, because that had been my process for 10 years. And that's how I did it. And once I started doing that, it all kind of fell into place. My wife thought I was absolutely crazy. She's like, what is wrong with you? I'm like, I don't know, but I've got to keep some form of normalcy to my schedule and go with it. And, gradually 5-minute drive became 2 minutes. Then it became just picking up my coffee and coming back, but sometimes little things like that are huge, just to give you, when everything's abnormal, put in little things that you can make normal that were the way you did things before. As you were saying before, in your own economy, beware of two things: small sample size. Beware of small sample size, meaning beware of the other agent or the other lender that goes, all of my clients are putting their home search on hold. All of my clients are not listing their homes anymore. You don't know, how many clients that is. You don't know how many clients they deal with on a regular basis. If it's your office's top producer, maybe be a little more, put a little more weight in what it is, what they're saying, because they obviously have a larger sample size. But if you have the client with one particular buyer that put their house on hold, and they're going around saying, "Oh, my buyers, hung it up today." Well, that could be true, but it might be one person. So beware of that. And then, your own economy, your own neighborhood, your own market is your own market. That's a great piece of advice. Kim and I have an Arizona branch. I'm in Marlboro and Worcester. My business partner, Kim, operates out of Bridgewater, Raynham area. We have another branch down there. The markets just between Kim and I in a 45-minute drive are wildly different right now. And I still have buyers out pre-qualifying and buying, and she's seeing things fall off a lot faster and a lot quicker down there. So, know that, because be mindful of where you're getting the information from. If it's coming from Hartford, Connecticut, that's been a long time troubled market, versus Worcester, which has been booming, and there's probably a large buyer pool sitting on the sidelines that could use a little bit of some price reduction or less competition to get back into it. So treat your business like a business, and do some market research. And if you need help with that, let us know. We have access to the Warren Group, CoreLogic. We have transactional data. I can't promise you I'll get to it this week, but when things slow down in the next week, 2 weeks, like let's look at heat mapping and let's see where transactions are being done, and let's look at where homes are going up for sale,
Yeah,
and maybe target those ponds.
yeah, that's an important point for any consumers that listen to this too. Is just working with a professional, experienced agent or an agent who has an experienced broker that can help them guide them with data and not snap decisions based on their friend that posted some ridiculous thing on Facebook. Is
Right.
we have to be careful what we post right now as real estate agents, because we can be judged right now. Just like I say, don't get into anything political on Facebook as a real estate agent. It's the same thing. I'd be careful what you're posting right now about COVID or what you're doing or not doing. It just is a heightened sensitivity right now for sure. So we have to be careful of that stuff. But from the consumers out there, it's people need a house to live in. We don't know for sure what the market's going to entail in the next 6 months, but typically there's data that can be analyzed by a real estate agent to kind of see where the trends are going. Are new listings down? Are under agreements holding steady? Are prices holding steady? And it is town to town. The last recession we went through, Shrewsbury, like for instance, barely had a drop, and any drop it did have over the first couple of years of that were minimal, whereas Worcester dropped hard.
Mm-hmm.
But I look forward to what's going to happen with this, and Worcester's a whole different scene now than it was. Even though the market was high back then in Worcester, you didn't have the revitalization, you didn't have the demand that Worcester has right now for both business and commercial and restaurant and retail, and it wasn't as booming before the market crashed last time. It's a whole different landscape. So I don't see it dropping as hard. Now that's right now. Is some data going to come out, and in 3 months from now, I'm sure I won't look at it any differently in the next couple months. 3 months from now, do we start to see some data that's leading us to believe something else? Probably, potentially. But it's just a matter of continuously looking at the data and seeing where the trends are going, and educating yourself on a consistent basis to try to help your clients make good decisions. But,
yeah, I do a lot of market research, and I think if agents are doing market research and they're not well versed on what it's going to take in their markets to succeed, not a lot happens by accident in this industry. And even when you think it is by accident, it's not. It's because you did the infrastructure and you did the background work. And that's really hard to keep sight on in times like this, because it feels like you're spinning your wheels, and it feels like you're spinning your wheels. And then 6 months from now, maybe, talk about this, Tracy, maybe fall market is the new spring market. Let's think about that. Like, spring market is being impacted right now. Weather's not all that dissimilar in the fall. Who knows what school years are going to look like? So that whole kind of traditional thinking could be thrown out the window. Maybe we need to pretend this is winter. Game of Thrones fans, winter is here. Like, let's pretend that's what this is right now. And spring market is now, fall market. Like, let's look at those shifts and be prepared for it, because the people that are caught sleeping are like, well, October's not as busy, November's not as busy, I'm just going to take that off too. That could be the time that all of a sudden everybody's, hammering, inventory pops up, or these different things happen. So
I mean, I can't look forward and believe that they're going to raise the interest rates dramatically. Right?
Oh yeah, I got to run, but let's talk about that real quick. Rates should be lower than they are right now, by and large. The deliveries of these mortgage-backed securities would let you believe, and where the 10-year treasury, the 10-year and mortgage-backed securities are not technically related, they're correlated. So when one goes one way, the other seems to follow. They've uncoupled right now. And with the 10-year where it is, rates should be much lower, but there isn't the capacity and the ability to offer these, nor do the lenders really want to, because it would affect the long-term servicing values, and it affects how the whole mortgage market works. But the feds did tip their hands the last 5 days. Let's say let's go back to last week, actually. At the end of last week, the Feds tipped their hands that they really want to push interest rates low. They said they were going to buy 200 billion and stop the tapering. They started buying anything that they could of mortgage-backed securities, and that created a whole new problem in the marketplace because lenders were hedging against the rates getting better, and the Fed kept buying and kept buying and kept buying, and that further created liquidity issues and margin calls for the lenders, which pumped rates up. So the Fed has tipped their hands that they want to keep rates low for a long time. There's another thing that I see: cash out refinances are not being priced very aggressively at all. A lot of lenders, there's some lenders that aren't doing cash out refinances. And the main reason I think that we're seeing that is because someone does a cash out refinance today. They fund. Next month, they want to refinance that. It's now a rate and term. It's no longer a cash out refinance. So if they do a cash out refinance today, 60 days from now, rates tend to hit market and they're lower. Those people are going to refinance into lower market correct rates and prepay those mortgages, which is going to devalue those servicing portfolios. So the market indicates that low rates are here for a long time, and mortgages have been, capitalism's cyclical hedge for a very long time. When things get bad, they lower rates. Refinances, when you do a refinance, you generally get to skip at least one mortgage payment, if not two, depending on the timing. It's a very good way to kick the can, reset people, get lower payments, create affordability. The lower someone's mortgage payment is, the more they have to spend elsewhere. So I think rates are going to remain low for some time because we've just seen a few of these tips. And if I'm watching lender behavior and I'm watching Fed behavior, that's saying that they're going to try to keep these things suppressed as long as they can. Right now they can't because they were buying all these mortgage-backed securities and prices to the consumer were not getting better. Again, for the other reasons we've hit ad nauseum, capacity and warehouse capacity. So those things you're going to see when things get back to normalcy, the Fed will probably do what they were trying to do here and help push those consumer rates as low as possible. So I think you're going to see this around for some time. And, anybody that I had in refinances that missed that first go round of really low rates, I have them what I'm calling the cell phone lot at the airport. We have all those applications stacked and ready for pickup. Once the market forces come in, we have their targets. We know what they're trying to achieve. Our rate systems are going to let us know, hey, pricing's in this area. My pricing engine's set up probably with 75 scenarios, and when I log in each day, 6 might be green. Those are the ones that are in the target range for today. So stuff like that, just pay attention to it, be mindful of it, work with lenders that know how to use these tools and know what is going on as far as where this industry money is being pushed and shoved. Can I promise you that rates aren't going to be low? No, but I can give you some facts and some information that are really showing that they're going to try to keep them low for some time.
Yeah.
And that's what I would be focusing on. Rates going up to 4.5%, 5% on top of this, that could seize things up, seize the housing market up entirely. And that's where a lot of wealth and revenue is generated here.
Yeah, I would tend to agree. So it's, I know you might have to run. I'm just going to talk quickly about a little bit more about number 6 for a couple more minutes, and then I'm going to end this. If anybody has any questions, post them in the share now. But thanks, Mike. Appreciate it. That was a great.
Yeah, sounds good. I'm going to take off. Thanks, guys. And one last thing I want to throw out there: if you're looking for some up-to-date, information on this, our Twitter at Mortgage Unity. We're going to start linking to things like forbearance. That's a big question right now. They just started the forbearance abilities. You have to apply for those with your servicer. As we get information on that, we're real time going to link it to our Twitter, and you can.
It's at Mortgage Unity.
Yep, at Mortgage Unity on Twitter. Right. Awesome. And we won't post to Facebook that stuff as quickly, so that's going to be the best place to get our news and information that we can pass along. Okay.
Awesome. Appreciate it.
All right. Thank you all. Thanks, Tracy. Thanks. Good luck out there.
All right, that sounds good. So the only other thing I wanted to kind of mention before we get off here for this webinar is just when we get out of this, whether it's a clear defined date or a transition over time, there's clearly, to me, there's going to be a new way of doing business in the future. I think it's going to be a long time before people feel safe doing certain things like shaking hands. I heard someone say the other day, is this the death of shaking hands? I don't know. It probably will be for a while for sure, but we need to, as real estate agents, start thinking about how we are going to proceed in the future differently than we did in the past. I don't think, obviously rapport building is an important thing with new clients especially. And I think we're going to have to start thinking about doing that more via Zoom meeting, more via recorded videos, introducing ourselves, anything we can do to put our face in front of our clients and hopefully our clients in front of us and our faces. I think you're going to see more and more absent showings where agents go out and preview a home via Facebook Live or video to their clients. I think you're going to see more virtual open houses in the future, more protection of sanitary wipes and hand sanitizer and gloves, maybe not masks, but I think for the foreseeable future, we're going to have to start thinking about our business differently than we did before. How we convert clients, how we communicate with clients, how we build rapport with clients, how we get them to feel confident in obtaining their goals in real estate. It's going to be a whole new world. We need to start thinking about that as real estate agents, and maybe we'll do that on another webinar, what the new real estate world will look like when all this is over. However, if you have any questions, I'm going to just quickly open up all the attendees. Anybody have any questions? I'm muting all you guys. If not, we'll just end it, but I just did want to offer an opportunity for any of you guys to ask any questions. Anybody out there want to ask any questions? All right. Did you guys find that webinar useful?
Yes.
All right, good. Glad you guys enjoyed it. Mike has always got a lot of great information, so it was good to have him on. It kind of, for me personally, it reiterates what I've been feeling about the real estate market and what it's going to look like in the future. So it's good to collaborate. It's good to listen to any and all people out there that are sharing their thoughts on this, that are backed up by real data and backed up by real experience and not just off the cuff hysterics. And so I think we all need to stay calm, stay positive as possible, and figure out day by day, week by week, what this new real estate world is going to look like. So thanks for joining us. I'm going to end the recording and make it available via a recorded video link on YouTube, and I'll share that on Facebook. Thanks, guys.
Thank you.